All right, in this lesson, we're going to go over the 7 components of the accounting equation. Now, as we go through this, we're going to kind of learn that there really is only 6 components, but we're going to talk about 7 components for now. And the reason why we're learning this now is so that when we go into the accounting equation lesson, there's less emphasis on what each component is and more about what the accounting equation has to do. Okay, so this lesson is all about getting you familiar about the 7 components that you're going to be learning and understanding what they consist of and what accounts go underneath them. So to start us off, we're going to start with assets. Assets are one of our 7 components. Now, what are assets? Assets are a resource a company owns or controls, and the company expects to yield future benefits. So what does that mean? Well, think about what types of stuff does the company own that realistically is to provide a future benefit or yield a future benefit. So the easiest one to think about is cash. Well, when a company has cash, they can use that cash to buy things, then to sell things to create more revenue. When a company has cash, they can use that money to do a lot of research development, which at the end of it hopes to bring out a new product, and that new product brings them more money. So cash is a resource or an asset that allows the company to yield some type of future benefits. And, other things that could be assets, equipment. When we buy a piece of equipment or machinery, we expect that machinery to do something, and that something hopefully allows us to create more revenues at the end of the day. Okay? So all of these assets yield some type of future benefit for the company, typically in the form of future revenues. Now, they don't have to have a directness to the revenues, but they usually have some supporting role to the revenues. For instance, if we buy a building, the building itself is not going to make anything, but we have to have the building in order to house all of our equipment and our people to make the product that we're trying to sell. Okay? So again, assets are resources that a company owns or controls that is supposed to yield a future benefit for the business. Now, examples of assets are cash, equipment, real estate, and accounts receivable. Okay? Now, there's many more than that, but those are just some of them. So I want you to understand there's many more, but these are just some of them, some examples. You'll learn some more as you go through accounting. Okay? Now, the new kind of term that you're seeing here, accounts receivable, you might be asking yourself, what is accounts receivable? Well, accounts receivable are things owed to us. Now, what does that really mean? Well, let's think about this as a kind of example, okay? Let's say you go to the grocery store, and when you go to the grocery store, you decide to buy some groceries. At the end of that transaction, you have to go out to the checkout lane. Now, if you don't go out of the checkout lane, there's going to be some nice, nifty jewelry that is silver that they will cuff to your arms if you don't pay for it, okay? So at a store, you have to pay for it before you actually get to keep it. Now, that's in the consumer world. In the corporate world, it doesn't work that way. Oftentimes, when 2 corporations are doing business, they will extend terms or a credit line to that business. So let's bring back our example of the grocery store. Let's assume a potato chip manufacturer comes in and delivers 30 bags of potato chips, okay? What doesn't happen is when that delivery driver delivers those 30 bags of potato chips, the delivery driver doesn't get a check for them. They merely just drop it off, put it on the shelf. Maybe their manager will sign it saying that they've received the delivery, and that's it. So what happens to the money? What happens to the billing? In the corporate world, that receipt that's been signed off by the manager saying that they received 30 gets sent to the accounting department, and the accounting department will issue an invoice to the grocery store. That grocery store then has 30 days, typically, to pay that bill. Those are called terms. That's called credit, okay? That's what businesses usually do. Why do they do this? Typically, it's more efficient. Okay, there's efficiency in there. Do we really want all of our drivers collecting checks on behalf of the company? Probably not. How weird would it be to try to get all of these credit card numbers to start charging all of these stores? A little bit tough. It's better to master bill them. And so there is some efficiencies and good internal controls by doing this. But because we don't get cash, we deliver the 30 bags, which means the revenue is complete. Revenue cycle is complete. We've delivered the 30 bags. But we're not going to get cash, so we can't book cash. Instead, in our accounting system, we book something called accounts receivable. So that's what a receivable is. We're giving terms out to a company, and we're saying, hey, we're going to deliver it to you, but you're going to have to pay us back in 30 days. Okay? There are some risks in it, but that's kind of how businesses have developed. Rather than consumers, we don't even trust consumers, so you have to pay for it up front. Now, some would argue, well, what about if I pay with a credit card? Well, technically speaking, you can pay with a credit card, but the company gets the money that day or the next day. Okay, so it's not you get to pay it in 30 days, but the company still receives the cash a day later. So really, their accounts receivable is not necessarily material because they're going to receive it in 24 hours time. Okay, so even though credit cards will give you 30 days as a consumer to pay, we don't really think about that as an accounts receivable necessarily. Okay, Okay. The next thing that we're going to look at is we're going to skip equity and we're going to go to liabilities. So what is liabilities? Liabilities is simply what a company owes its non-owners, we call them creditors, non-owners, creditors, in future payments, products, and services. Okay, so a couple things here. First thing, non-owners. Okay, we're not talking about owners. If owners gives money to the organization, that owner necessarily doesn't expect that money back. Okay, that is an equity, not a liability. Okay, so non-owners or creditors, those are people that we owe money to. And then the second thing part of this definition is in future payments, products, or services. When we think about liabilities as a consumer, we think, oh, payments, things that we owe, money that we owe to another person. However, it could be that maybe we don't owe them payments, but maybe we owe them a product or we owe them services. We'll talk about that in a minute. But so liabilities aren't just money that we owe. They could be products or they could be services. So let's talk about some of the accounts and liabilities. Some of the accounts includes accounts payable, notes payable, unearned revenue, and accrued liabilities. All of these terms are probably new to you, so we're going to go through them each, starting with accounts payable. Accounts payable is the opposite of accounts receivable, so it's kind of the same thing, but the opposite. Let's take it back to that grocery store example. If you were the potato chip company, you would be booking an accounts receivable because you expect that to be owed to you, paid to you. But what about if you're the grocery store? Well, if you're the grocery store, it's accounts payable, okay? You owe that to the potato chip company. Because you owe that to the potato chip company, you owe them money. You've received the goods, now it's time to pay up. So we call that accounts payable. Now, students often confuse accounts receivable with accounts payable. What's the difference? Accounts receivable, I receive, therefore it's an asset to me. Because I receive, it's an asset to me. This is different from accounts payable when I'm going to pay. So because I have to pay, it's a liability to me. I don't get it. So it's a liability, things that are owed to accounts payable. So that's how I remember it. Accounts receivable, because I'm receiving it, because the word receive is in it, that means it's an asset to me because I'm going to get it in the form of cash and I get to do something with it. Accounts payable, pay, because I'm going to have to pay it, it becomes a liability. Now, notes payable is like an accounts payable. The only difference really with a notes payable and accounts payable is that a notes payable typically has some terms in it, and typically there is a signed document, note, for it, and typically there's an interest rate and a time period, okay? Now, we can make the argument that, well, doesn't an accounts payable have an interest rate? It could. Does an accounts payable have a time limit? It does. But notes payable are more formal in nature. So let's bring our example back. Let's say on that 30 days for those potato chips, before I leave the store, I get a signed note that says, this store promises to pay me, the potato chip company, $30, let's say each bag's $1, $30 in 30 days at an interest rate of 1%. Okay, which means when they pay me in 30 days, I'm going to charge them $30 plus 1% in interest. Okay, so notes payable typically has those terms, and then they sign it, and then I sign it, and that's the agreement. With accounts payable, it doesn't really work that way. With accounts payable, if I'm the delivery driver, I'm just going to deliver it. they're going to sign that they received it, not a promise to pay, just receive it, and then I'm on my way. That's kind of how accounts payables work. They're not necessarily formal in nature, but the issuance of an invoice is a formal document. Okay, so that's how we know there. You're going to deal more with accounts payable than notes payable. Notes payable will have to be told to you that there is a note attached to the payable. Unearned revenue is when you decide to pay someone in advance and now they owe you a service or a product. So remember, our definition of a liability is things that are owed in the form of payment, services, or products. Okay, so unearned revenue, a great example of unearned revenue is like the airline. If today I go and I buy a ticket for transportation to X, Y, and Z state, I have to pay them today. But the company doesn't earn the money today. They earn the money when my butt's in the seat and they fly me to my destination. If they don't fly me to the destination, it's not revenue that has been earned, therefore it has to be returned to me. Now, that's unearned revenue. It's revenues, but they haven't earned it yet. When do they earn it? They earn it when I fly and I get to my destination, and oftentimes it's a round trip, so they've earned half of it when I get there and half of it when I come back. Okay? Now, some people would say, well, what about if it's a non-refundable ticket? Well, technically speaking, if it's a non-refundable ticket and they don't know you're not coming, it's still an unearned revenue until they fly. Once they fly, then it becomes revenue to them as a canceled ticket or as a ticket that wasn't used. But just because it's non-refundable doesn't make it revenue right away. Okay? Now, when does the non-refundable ticket become revenue prior to the flight? It's when I call up and I cancel it. So for instance, if I buy a $300 ticket for a flight and I cancel it, so 3 days later I say I can't go on that trip, I cancel it, there typically is a cancellation fee that is taken off that $300. So let's say it's $200. So I cancel my flight, they give me back $100, but then they keep the $200. That is when that $200 now becomes revenues and not unearned revenue. So it's taken out of unearned revenues, $100 goes back to the owner, and then $200 gets booked into revenues as a canceled trip cost. Okay, so that's the only real time that we're going to book an unearned revenue prior to providing a service or revenue or service or a product. It's when it's fully canceled and the terms of the agreement says that they had to pay a cancellation fee. Another way that you could think of it is we could give back the owner the $300 and then charge them the $200 for the cancellation fee, but that's just too much work. So we're just only going to give them back $100 and we're going to keep the $200 and take it out of unearned revenue and throw it into finally revenue. Okay? Last one over here is accrued liabilities. What is accrued liabilities? Accrued liabilities are liabilities that a company accrues but has not been billed yet or has not paid for it yet. Okay? An example of an accrued liability could be the electricity that you're using in your home. When do you get billed for it? You get billed for it at the end of the cycle. Okay? Why do you get billed for it at the end of the cycle? Well, the electric company doesn't know how much electricity you're going to be using in the month, therefore they can't bill in advance. So, for instance, I might have electricity on right now, but I'm not going to get a bill at the end of the day requiring me to pay it today. They're going to accumulate all of that, and then at the end of the month or the period, they're going to send me a bill, and then I'm going to pay that bill. Okay? That's an accrued liability. I'm accruing the liability, and then I'm going to pay it at some other date. Now, another example of accrued liability could be payroll. So for companies, it's payroll. We bring in a new worker. That new worker works for 2 days. We don't pay him after the 2 days, and we don't even pay him after 1 day. We pay him in 2 weeks when the payroll cycle comes. So what happens in the books? We accrue, we book the expense with a liability, and then when we pay this individual, then we will reverse the accrued liability, but the expense will already be on the books. Okay, so that's what accrued liabilities are. So liabilities, examples of liabilities are accounts payable, notes payables, unearned revenues, accrued liabilities. Okay, let's jump over to equity. Equity is a little bit different here. This is one of our 7, although once we talk about the other 4 here, we usually drop off equity and then there's left with 4. So instead of 7, we get 6. Okay, 7, 6. Okay, so what is equity? Equity is a claim of its owners. Okay. So what does the owners claim the assets of the organization? Okay. Another way we can think of equity is through this equation called Equity equals owner's investment minus owner's withdrawal plus revenues minus expenses. So again, equity can be known as owner's investment minus owner's withdrawal plus revenues minus expenses. Okay? So owner's investment, owner's withdrawal, revenues, and expenses. Okay? So that's what equity is. Now, typically speaking, if equity equals owner's investment, owner's withdrawal, revenues, and minus expenses, then we're going to use those as our components. So that's now we can say that we don't need equity anymore because we now have these four that represents equity. So let's start with the first one, owner's investment. What is owner's investment? Owner's investments are resources such as cash that an owner puts into the company. Sometimes the resources can be other assets. So if we think about it, owner's investment, when we start a company, we are going to have to put assets in the company in the form of cash or equipment or supplies or some type of transportation or even a building. So we've got to put some things in the company, otherwise the company can't even start without some type of asset, resources that yield a future benefit. Okay? So when an owner puts in money into a company, that's called owner's investment. When the owner puts in, like, let's say a laptop, even though that laptop's not cash, that's still an owner's investment in the organization. Okay? So again, owner's investment doesn't have to be necessarily cash only. It typically is, but it can be other assets. Examples of owner's investments are common stock, capital stock, additional paid-in capital, or APIC. Okay? Now, let's say the company goes through the couple of years and then needs more capital. We can then put more owner's investment in the organization, okay, or the business. Okay? It could be in the form of more common stock, more capital stock. Typically speaking, it's more additional paid-in capital. Just like it says, additional paid-in capital, more additions of capital into the business. Okay? So that's owner's investment. Now, you might say, well, you just said equipment, so where's equipment? Well, when we say equipment, we take the fair market value of the equipment and we put it in here as common stock, okay, or additional paid-in capital. Because at the end of the day, what's happening? You're giving up the right to that asset. In return, you're getting capital in the company or ownership in the company, okay? Next one is owner's withdrawal. Owner's withdrawal are resources such as cash that an owner takes from the company for personal use. So an example of that would be dividends. Now, if you're in business as a sole owner of an organization, what would you want to do at some point? Well, hopefully you would want to take some profits from the organization. Well, those profits, when they're returned to you, are called dividends. They are not called salaries. Now, there is a distinct difference. If you're an owner and actually participating in the organization, you might have a salary. That salary gets deducted from net income. And then after that, you're going to have a net income, we would hope, a net income, and some of that gets distributed to you not as an employee, but as a shareholder of the organization. Another way to think about dividends is that, let's say I decide to own a part of your company, but I don't want to be an employee. I just want to be an owner. Well, hopefully at the end of the day, you're paying yourself a salary for managing the company, but there must be some profit at the end of the day. Well, that profit, some of it gets returned to me because of my investment in your company, but I was never an employee. So it's not a salary to me, it's a dividend, my share of the profits because I am an equity investor in your company. Okay? So we use a technical term called dividends for corporations. For a lot of small businesses that are not corporations, we usually just call it owner withdrawal. So there's a difference in terms here when we talk about owner's withdrawal and dividends. Okay? Let's move on to the next one, revenues. So revenues are pretty easy to understand because we've talked about them before, but revenues are the sales of products or services to customers in the normal course of business. Examples of revenues can be sales and sales revenues. Okay? Now, one thing to remember that we've talked about, revenues aren't necessarily when you receive cash. Okay? Revenues can be when you've done the service, you've delivered the product, the revenue cycle is complete, but we haven't received the cash. Remember we said that the revenue principle says that once we've completed our service, once we've delivered the products, the revenue process is complete. Therefore, we're going to book the revenue even though we didn't receive the cash. So we still book the revenue regardless of when we receive the cash. Moving on to expense, which is the last item under the equity. Expenses are costs necessary to earn revenues in the ordinary course of business. So you remember the matching principle? The matching principle said we are going to match our expenses to the revenues that we receive. Okay? And so because we are matching, we're going to book the expense when the expense is incurred, but may not have been paid yet. Okay? So for instance, if we get to the end of the month and we've had, let's just say we're estimating $500 worth of electricity expense, just because we didn't receive the bill, just because we haven't paid it, doesn't mean we don't book it. We're still going to book an expense for $500, but we're going to probably also book an accounts payable for $500 because we're going to owe the utility company that $500 for the usage of electricity that we have incurred during the period. And I'm sorry, not accounts payable, accrued liabilities. Okay, accrued liabilities. We'll turn it into accounts payable when we receive the bill. Okay, so expenses don't have to be booked when they've been paid. They're booked when we've incurred the expenses. Examples of that would be cost of goods sold, utility expense, and payroll expense. Okay, what is cost of goods sold? Cost of goods sold may be a new term to you, but that's when I buy inventory and I have to hold it as an asset until when? Until I sell it because of the matching principle. Okay, so if I buy, let's say I'm a t-shirt seller and I buy 100 t-shirts at $1 a piece, that means my inventory is $100. That's going to be booked as an asset first. And then let's say I sell one shirt. When I sell that one shirt, because each shirt costs me $1 a piece, I will expense $1. So I'll expense $1 under cost of goods sold. How much did that goods cost me? $1. Okay, so the cost of the goods that I sold cost me $1. So I'm going to book a $1 expense, which means how much of inventory do I have left? Well, I started with 100. I subtracted $1. I have now 99. Okay. The rest of this is pretty self-explanatory: utilities expense and payroll expense. Okay. So if we have a utilities expense, we're going to book that there, and then payroll expense, we're going to book that there for salaries or hourly wages. Okay. So kind of breaking this all down and understanding what we've done here. What we've done here is we've learned 6 components. Now we have 7 up here, but equity is also known as all of these put together because of this equation right here. So really we have 6 components, okay, instead of 7. But we have 6 components, and then we have all of these things down here. What are all these things in blue? Those are called accounts, okay? So one thing that I want you to understand before we go into our next lesson is we have these components, and then we have all of these accounts. Now let's take this as an example. Let's assume that we are a bank, okay? So let's say we have 7 banks. Now if we go into the bank, can we have multiple accounts? Well, yeah. When you go into Wells Fargo, when you go into Chase, or when you go into Bank of America, you can go in there and you can have multiple accounts at the same bank. So let's assume that we are an asset. We're the asset bank. Can we have multiple accounts in the asset bank? Well, yeah, we have multiple accounts. So as you can see here, we have a component asset, and then we have all of these accounts. And there's much more, like I said before. So the reason why this is important is when we do the accounting equation, when we do the journal entries, we need to understand what type of account are we dealing with. That's going to help us tell us how we book it into the books. So it's very important to understand this idea of components and accounts. There are 6 components, and within each component there's a whole bunch of accounts. Okay? So if I asked you, what type of account is cash, your answer should be asset. What type of account is equipment? Your answer should be asset. What type of account is notes payable? Your answer should be liabilities. What type of account is dividends? Your answer should be owner's withdrawal. Okay? So all of these accounts has components. There are only 6 components. If you know the 6 components, then you know that you have a 1 in 6 chance of saying that is either an asset, a liabilities, owner's investment, owner's withdrawal, revenues, or expenses. Okay? So this is an important lesson. It's a long lesson, but it's important for a couple reasons. The first reason is so that you understand what the components are. What is an asset? What is a liability? What is an owner's investment, withdrawal, expense, and revenues? Okay? The second thing is what accounts go in this. Now, to be very honest with you, as you go through your accounting career, you're going to learn more and more accounts, and those accounts you'll start to learn what type of components there are. So you're not going to know all of the accounts right off the bat, but as time goes on, you're going to learn a new account, and then you're going to ping that to a component. Learn a new account, component, new account, component, new account, component. That's how you're going to learn it. So I can't just give you a list of all the accounts you need to know, but as you start going through accounting, you're going to know these accounts and you're going to see how they're components. Okay? The third thing is once you're familiar with all of this, the accounting equation becomes a little bit easier from a journal entry standpoint. So we use this to help us understand what journal entries we make into the books following the accounting equation. So I know it might seem like we're spending a lot of time on this, but you have to understand this. And then the next lesson is all about the accounting equation, understanding that. And then in another lesson, we're going to talk about the accounting equation, and that's where all of this is going to make sense. Okay? So those 3 lessons are going to be important to understanding how do we actually do the physical accounting at the end of the day.